Good morning, everyone. Not sure if you could hear that. So just wanted to welcome everyone to episode 42. I am Leslie Wyatt. This is Saved You a Seat. Today, we are going to dive into a 2023 industry and regulatory update. I am going to warn you all now, I have a slight cough, so that is sad for you that you guys have to hear me cough. I have some liquid here, and hopefully I can make it through without driving you guys crazy. But we wanted to thank you for joining us. Today is actually our first one of the year. So you guys are the winners. You get to go to the first one of 2023. So we thought we'd kick it off with an industry update. We have a lot of really exciting good ones planned for the future that hopefully you can join us on as well. Just so everybody knows, we record these per usual, and Ellen Crema and our marketing team will follow up each Saved You a Seat webinar session with an email with kind of a recap and links to the recordings and our blogs where you can find information. You're welcome to use it, internally or training or whatever you need. Please feel free to ask any questions. We do have a chat and question feature within the webinar that you can certainly utilize, and we'll try to get to as many as we can throughout the session. If we don't get to them all, we're happy to reach out to you individually. So Ellen is also on right now, and she's going to kind of monitor the questions for me, and she's welcome to interrupt me or stop me at any point, or I can get to them at the end. So with that housekeeping taken care of, I think we will go ahead and get started. So as I mentioned, we are going to kind of just take a look at our industry, see what's happening right now regulatory-wise, and just overall in the market. The past 2 years have been a little bit crazy in our industry, and now we're kind of seeing a little bit of normalcy, which, some are kind of viewing as a downfall in the mortgage market, and it certainly is slower than it's been. But we're going to talk about that a little and how it's not necessarily a bad thing. And we're not really thinking we're going to see a big crash like 2008 or anything like that, and we'll talk through that. We are going to talk quite a bit about the CFPB for a change. For a while, I feel like they were just kind of a slide or two when they were, more just kind of updates of where they were, who the new director was, stuff like that. But they've been quite busy. They've had quite a few enforcement actions. We're going to talk through some Capitol Hill updates, what's the hot topics right there, which is timely for those of you that may attend the ALTA Advocacy Summit in May. Some of these topics will be some of the ones that you'll be discussing when you're there. We do have some ALTA updates, and we will go ahead and take a look at the market, like I said. Okay, so CFPB. The CFPB obviously is something that we are all too familiar with, and I'm going to ask for Ellen's help here because I keep getting a thing to start the broadcast, but it's Hey, Ellen, can I just call on you for a second here? Did everybody hear my beginning piece there, or do I need to start over?
I think that it just started. We haven't gotten any comments. All right, we got one. I think that you need to.
There you go.
I think we are good now. Sorry, everybody.
Okay, so. All right, we're not sure what happened with the webinar there. We had it recording, it stopped recording, so I've basically been talking to myself, which is nothing new for me. I have 3 teenagers who like to ignore me. So with that, we are going to go ahead and get started. Essentially, all I did was just go over some housekeeping, but I'm going to go ahead and do that. A lot of people ask us if they can get copies of the recordings and where they can find this information. Our marketing team will follow up this webinar with an email, a little bit of a recap and a link so that you guys can have access to it, and also a link to our blog, which you'll find a lot of the articles on. If you have any questions, please utilize the question or chat feature here in the box in the webinar. I'll try and monitor it, but we also have Ellen Crema with SoftPro on who will monitor it and let me know if we have any questions. I'll try and get through as many as I can. If I don't get to your question, I'm happy to reach out to you one-on-one. If you have any questions or thoughts after the webinar, please don't hesitate to email me. My email should be easily accessible, but if not, it's leslie.wyatt@softprocorp.com. and I will just go up and just kind of quickly recap some of the things we're going to talk about. We are on episode 42, 2023 Industry and Regulatory Updates. And believe it or not, this is our first one of the year. We kind of took a little bit of a hiatus. We were real busy at the office, so we thought we'd kick it off and just kind of talk about where we are as an industry. We are going to focus today on CFPB. We've got some hot topics going on there, whether or not it's constitutional, whether or not their enforcement actions and some of their legislation is going to stick. We are going to get a Capitol Hill update, and I was mentioning that if you are going to attend the ALTA Advocacy Summit coming up in May, some of the topics we are going to talk about today are also going to be hot topics while you're there. We are going to give an ALTA update. We got some forms and best practice updates to talk about, and then we're going to talk about the market. And while I was talking to myself, I did talk a little bit about it and just simply saying, the last 2 years, I think we can all agree were unprecedented and a little bit bananas. And now we're seeing some normalcy and stability, which a lot of people are worried about it leading to a crash, if you will, kind of like an 08 situation. It is not set up like that right now. We will talk through it when we go through it. And we'll talk about some of the good things that are happening, and there's some things that we need to look out for. So with that, I am now going to get started, and I can assume, since no one else told me they can't hear anything, and Ellen can obviously hear me, that we are good to go. Okay, so we're going to start with the CFPB, and like I mentioned earlier, they've been kind of quiet. They've been there, and they quietly do their thing. I will say they are not quiet right now. There is a lot going on with them. So the hottest topic going on with that is not actually an enforcement action, but it comes from a payday lending law that they put into effect in 2017. So before I get into this, just a little bit of the background is Community Financial Services of America sued the CFPB in 2018 in response to the payday lenders payday lending rule, which they put out in 2017. It essentially regulated payday loans, vehicle titles, and other loans. So on behalf of all payday lenders, they went ahead and filed suit saying this was an overstretch and that they were essentially prohibiting them from doing business as necessary. So fast forward, multiple court cases regarding this, and it comes up into the Fifth Circuit Court of Appeals. So it was a 3-panel judges, and they said, you know what? We don't think what they did in the payday rule of 2017 is unconstitutional. We think that was within their realm. But what we do see a problem with is that they receive their funding directly from the Federal Reserve rather than the usual congressional appropriations process. So when they came out of this, they said, we're not going to say that they're wrong in their payday rule. What we're going to say is that their funding is unconstitutional because it's in direct violation of the appropriations clause and the Constitution's structural separation of powers. This is huge. This is more than the Community Financial Services could have ever dreamed of. So why they didn't necessarily say they were out of, their jurisdiction in that payday rule of 2017, what they did do is say, because the CFPB was using funding that they deemed unconstitutional while making that rule, we're going to vacate that payday lending rule until further notice. So the court said without unconstitutional funding, the Bureau lacks any other means to promulgate this rule. Basically what they're saying is, if they had gone through the constitutional process and they did have to answer to Congress, they may or may not have gotten that funding. And they're saying without that funding directly from the Federal Reserve, which is not where they should be getting their funding, they wouldn't have had the means or resources or staff to even write or promulgate the rule. So plaintiffs were thus harmed by the Bureau's improper use of unappropriated funds to engage in the rulemaking at the issue. So it was not the outcome that anyone was expecting at the time. It certainly was not the outcome that the CFPB wanted. This kind of goes back to the case in 2021 when they said, it made it all the way up against the Supreme Court, and it said, it eventually said, listen, they're within their rights here, but when we're looking at the CFPB, the structure is not okay. You can't just, have one person be in charge of everything. Someone has to be able to remove them at will. I think it was the Scalia law one, right? Scalia law. So they had to make a change essentially to Dodd-Frank to say, hey, the president can remove them at will. So again, the same thing happened. Somebody went after the CFPB for one thing, and it became a bigger constitutional issue with the Supreme Court or the Court of Appeals saying, listen, that's the bigger issue is you can't be in department of our government. You're with basically a free checkbook, if you will, right? Now, they argue that they are only allowed to ask for 12% of what the Federal Reserve reserves are, essentially, but that is essentially an enormous amount of money. So they need to and should be going through Congress appropriations to get their funding. So if we keep going through with this, the ruling calls into question the validity of the rules that the CFPB has issued. So essentially, because they vacated that payday lending law of 2017, they're saying you kind of have to look at all of it because they wouldn't have had the means or resources if they didn't have this money. And since they obtained that money unconstitutionally, meaning they didn't get the correct appropriations, we now have to look and see if the validity of everything the CFPB has done. So it's saying, it has potential implications for federal agencies funded outside the congressional appropriations process, which makes sense. They shouldn't be able to just get money from wherever they want. So in response to this, the CFPB says, we are not going to go to an en banc. We're not going to request that. We're going to file a petition with the U.S. Supreme Court, and they did that on November 14th on 2022. And what they did is they asked it to set a case for argument for this term, which has since passed. And they say, hey, we want you to expedite this. We think that this is important. We don't want this black cloud hanging over our head over the next however many months it may take you to hear it. We want the outcome now. So they said, we are asking you to hear it now, given the significant consequence of the outcome for the entire financial service industry. Because I always like to remind people, I know we think that the CFPB was essentially put in place to monitor us, but it wasn't. It's all consumer finance. So the outcome to this is not just specific to the mortgage industry or title industry. Fast forward from November to February 27th of 2023, the Supreme Court announced that it would grant the CFPB's petition, meaning they would hear the case. However, they did decline to expedite the case. So they declined to expedite the case. So they're saying, we are not going to push you ahead of the other people in line, the other cases. We're going to hear it in the order that we received it. So we will hear it, which isn't, the first step, but we are going to decline to expedite it. And we are going to hear it again in the next term, which is this fall. And then we expect to hear a ruling from them in the spring of 2024. So they did get granted that it would be heard by the Supreme Court, which in itself is a feat, but they didn't get it as fast. So now they kind of have this black cloud looming over them, right? Like I just said. So everyone's saying, well, are you going to go full force? Are you going to kind of lay low in 2023? What are you going to do? Because you've got basically a Supreme Court case against you stating, we don't think anything you've done to date is valid because you didn't get the money the way you should. So, what is at stake? What was in their petition? So the sole question presented by the CFPB was whether the Court of Appeals erred in holding that the statute providing funding to the CFPB violates the appropriation clause and in vacating a regulation promulgated at the time the CFPB was receiving such funding. So it's specific to this particular 2017 payday rule, but if the Supreme Court upholds the appellate court, the circuit court ruling, then they're saying almost all their decisions where they got money outside of the appropriations process would need to be vacated or at the very least looked at. So it's a huge deal. So here are some of the potential outcomes. And mind you, I am not saying which one of these is going to happen. I've just had a lot of people ask me, hey, we understand this is a big deal, but what do you think might happen? I have no idea what they're going to go with. To be quite honest, I would not even be able to take a guess. You'd have to probably talk to someone who an actual CFPB special attorney type thing, but even they probably don't know. But I did break down some of the actual potential outcomes just so that everybody could have an idea of what they would be. So the first one is they could strike the language specific to funding with zero directive back to Congress, meaning they can go in to Dodd-Frank and say, nope, we're going to take this out. And essentially what that does is it freezes the ability for the CFPB to function until Congress steps in. So the Supreme Court can take out that verbiage and essentially say, that's all we're going to do. And now it forces the hand of Congress to come in and take action. So by that, perspective, it's possible that everything the CFPB has done would be found null and void. Now, if Congress does step in, which they would, and successfully restructure the CFPB to meet these constitutional requirements, the acting director, or whoever the director is at the time, can go back and attempt to ratify all past actions, which would be exactly what they would do. They're not going to null and void everything they did, but that would probably lead to a lot more litigation, right? And all of these people who maybe paid fines or had to follow rules that they deemed harmful to their business are going to come back and say, hey, whoa, when this was put onto me, they were illegally functioning as the department of our government. So I don't know what that likelihood is, but that is one way the Supreme Court can come in and rule, but not take it too far. They cannot take it out of Congress's hands or say, hey, we're going to take this language out. We're not going to say what you need to do, but you know what you need to do. So the next one is they can strike that offending language, just like I said before, from Dodd-Frank, but they can then send the funding question back to Congress. So instead of kind of just taking out the language and saying, okay, we're done, they can take it a step further and they can force Congress to decide how it should be funded. They can also likely give them a timeline. If they're going to take it that far, they would go ahead and take that language out, and they would go ahead and say, hey, Congress, you need to step in, and it needs to be done by this date. Now, a time frame would be pretty hard to meet if you really think about it, because remember, we're not expecting a ruling to 2024 and the spring of 2024, and in the middle of essentially a pretty probably heated presidential election. So Congress might not be able to meet the deadlines. We don't know. So maybe that makes the first one more viable. Maybe it doesn't. I don't know. So one is they take out the language and they just kind of say hands off, and they hope Congress steps in and does what they're supposed to do. The other one is they take out the language from Dodd-Frank and they force Congress to do it, and they put them on a timeline deadline to do it as well. Both instances are likely, if they don't act quick, will likely null and void what the CFPB has put into place thus far, which is pretty wild if you really think about it. The last one is the court could rewrite Dodd-Frank to place the CFPB under the authority of the House and Senate Appropriations Committee. This would be a less likely scenario, and the reason being is that, the Supreme Court likes to make their rulings, but they don't really want to take, per se, the pen out of, the congressional hands. They're not in the business of, making the rules and writing the rules in legislation. They're in the business of enforcing them and making sure that they're constitutional. So while this is an option, it is probably a least likely scenario, because they're not going to want to step in and say, we're going to essentially rewrite what Congress did. They generally don't do that, and I wouldn't expect them to do it here, but it is a possibility. And then the other one is to do nothing and rule in favor of the CFPB. They essentially say, hey, they've been working under Dodd-Frank. They've met the requirements of what were put into place when Congress wrote Dodd-Frank. It's not their fault that they're nowhere in there said it had to get their money and go through the Appropriations Committee and the Appropriations Clause. So they did nothing wrong. They followed the letter of the law as it was written for them in Dodd-Frank. So the question isn't like, did the CFPB do something wrong? It is the CFPB constitutional in the way it was created and written? So they can do nothing, and they can simply just say, listen, unless Congress wants to step in on their own and address this and rewrite that portion of Dodd-Frank, then we're just going to leave it alone and let it stay as is. So it's pretty unique and pretty extreme options here. I'm sure everybody will be waiting across all the financial industries as to what's going to happen. I know I will be, because I'm a total nerd when it comes to this stuff. And I really don't know. I don't think the third one is an option. I don't think they'll rewrite it themselves. I think they would either do 1 or 4, but that's just me. I don't know that they'll put a deadline on Congress because, again, that's kind of overstepping a reach as well. But again, please note, these are just my, projections. They're personally mine. I don't know. No one knows what they're going to do until they actually hear the case sometime this fall.
Hey, Leslie, we have a question related to that.
Yes.
Someone asked, and I don't know if we have information on this, but they asked, didn't someone in the title industry try a similar lawsuit against the CFPB about 10 years ago, where the CFPB's response was to increase a fine against the title company? We have recollection of that, or is this case truly different from anything that we've seen before?
Yeah, I mean, this case is different in as it was specific to a rule that was put out and then deemed unconstitutional. I mean, the question is correct in that there's been multiple times that people have gone after the CFPB and questioned their constitutionality. And one of them was for the structure regarding who's in charge. And at the time it was Director Cordray, who did, respond to any time they were questioned was to basically hand out as many fines to kind of, I don't know a better way of saying it, but to kind of show their flex, right? So, it has been brought up in the past. It has not gotten this far as into a Supreme Court hearing, specifically as to this particular funding. It's been in lower courts and not gotten any further. I mean, a company has to invest a lot of time and money to take it this far with the CFPB, who really at this point has endless money, right? And so a lot of them have taken it to a certain point. Scalia won in 2021, but that was about, having one person in charge and how they couldn't be fired. Basically, they weren't accountable to anyone. And the CFPB did lose that. And so it'll be interesting. This is the first time it's gotten this far and a company has stayed with it and is willing to go to the end to see how it goes. So a little bit different, but yes, there has been multiple occasions where people have tried to go after the CFPB claiming various different reasons why it's unconstitutional, but this is the furthest anyone has got regarding this particular topic. Are there any other ones, Ellen?
Nope, that was it for now.
All right.
Yep.
All right, well then I'm going to keep going with all the exciting stuff from the CFPB. Also, just know you will for sure be getting a Safe to Receive webinar this fall regarding this case, because everybody will be watching this in every aspect of consumer finance. We will definitely do a follow-up to the Supreme Court case. I will be following it, obviously, because I'm fascinated by it and I have my opinion as to I think how it should go. So we'll see what happens. So in the meantime, they're not shying away, because you remember the judgment from the appellate court, the Circuit Appellate Court, came out in November, right? And then they filed their petitions with the Supreme Court, which came out in February. They said, okay, we'll hear it, but not till the fall. But they didn't let that decision in November slow them down. Instead of saying, okay, maybe we should lay low, maybe we're not constitutional, maybe we shouldn't be out there doing crazy stuff, they went all in. I could go on for the next 3 hours of enforcement actions that they did over the past year, but I just pulled a couple highlighted ones that you may already know about or have heard about. Probably the most prominent and biggest one was in December, which is after that appellate court ruling. They reached a record $3.7 billion settlement with the CFPB and Wells Fargo over various abuses. I'm too many to list because they list everything they can find related to auto loans, mortgages, and deposit accounts. So Wells Fargo and CFPB for months and months and months went back and forth, and the final agreement that they reached was a $3.7 billion settlement, which is absolutely wild. So to break that down, the CFPB ordered Wells Fargo to pay $2 billion in consumer redress, meaning back to the consumers for wronged or abusive actions. And in addition to the $2 billion that they expect them to pay back to their customers, they are to pay a $1.7 billion civil penalty, which is the largest fine the CFPB has ever levied against a single financial institution. So even after an appellate court is saying you are not constitutional, your structure is not constitutional, everything you've done is for money that you shouldn't have gotten or you got the wrong way, they still went forward and imposed the largest fine that they've ever put on a single financial institution. That tells you a lot about their competence or what they want your competence to believe, that they feel like they're in the right, that they're going to be fine. I will say at this point, they didn't know the Supreme Court was going to hear their case yet, but they had already filed the petition and they'd already been ruled against in the appellate circuit court. So the settlement far surpasses the $1 billion that they levied against Wells Fargo in 2018 for overcharging consumers on mortgages and, again, mishandling auto insurance. So their reasoning for having such a high price tag is they are trying to prove a point to impose stricter penalties on what they identify as repeat offenders. So they're saying, hey, Wells Fargo, we've already been through this with you. We've talked to you about it. You got $1 million fine or $1 billion fine, sorry. And here we are again in the same boat. So this time we're going to go ahead and triple that or almost quadruple that. And you're going to pay $1.7 billion basically to us and $2 billion back to your customers in fees that we think you should not have charged them. I mean, that's a really big flex in the middle of a lawsuit that is saying they don't think you should even be able to do what you're doing. So they're definitely not going to shy away from, which the original thought by most attorneys and most, CFPB or RESPA people, when that ruling came out in November, was indeed that, maybe we'll see kind of a lull or a kind of quiet 2023 from the CFPB, because they're not going to want to draw a lot of attention to what they're doing right now until this is all sorted out, which obviously is not the case, because here we go with Wells Fargo having the largest fine ever against a single financial institution. In addition to Wells Fargo, we also have Carrington Mortgage. They said Carrington Mortgage wrongly charged fees, provided false information about pandemic protections, and then also inaccurately reported homeowner credit information. Essentially, to sum that up, they're saying, listen, you did not provide your customers the COVID pandemic relief that we put out there in the CARES Act. And when you didn't let them know what was available, and you also told them they didn't qualify for when they did, at least that's what they claimed. And then in addition to that, what you did was when someone didn't pay on time because they thought they were covered by the CARES Act, you went ahead and reported it to the credit bureau. So they went after Carrington pretty hard, and they said essentially you've got to provide redress to your consumers, meaning they've got to ensure any improperly charged late fees are refunded to customers. They need to repair its faulty business practice, because they said that during an audit they found that this particular banking company was not up to date in training as to the CARES Act, and they didn't really follow any agency or GSE guidelines. And so that some of this may have been unintentional, some of it they feel is intentional, but just of employees not even understanding who could or could not utilize the CARE Act and what the outcomes for it were. So they have to go through a whole training. They need to establish policies, procedures to prevent these issues from reoccurring. They also, in addition to returning the money, late fees, and the training, and do an audit of all of their policies and procedures when it comes to CARES Act, they have to pay $5.25 million in fines, which will be deposited directly into the CFPB's Victims Relief Fund. So we see this now in all of their orders that they put out there. They didn't in the beginning, and everybody always used to ask, where the heck does all this money go? So now what they do when they do issue a final order against an entity is they do go ahead and they spell out the amount of money that's going to be put into the Victims Relief Fund, so that people don't think it's just going right back into the CFPB's pocket. So at that amount there may not disclose the portion that does go back to the CFPB, but $5.25 million is going into the CFPB's Victims Relief Fund. So last enforcement action here is Regions Bank. Back in September of 2022, CFPB issued an order of consent stating the bank committed unfair and abusive and practices by charging unlawful surprise overdraft fees. The Regents went back and forth with them for quite some time and said, no, we didn't, or it was unintended, and so on and so forth. But essentially, they too need to pay redress to affected consumers, that they need to pay $1.1 million in illegally assessed overdraft fees back to their customers. That's a pretty large amount, $141 million. They are prohibited from charging what they refer to as authorized positive overdraft fees moving forward, and they must pay a $50 million fine as penalty, which also will be deposited into the CFPB's Victim Relief Fund. So they're being more specific as far as where their funds are going, and I think that's good. I think people always kind of wondered, like, what are they going to do with that $50 million? You know, how easy it is for victims to get or access any of those funds for relief would be an interesting topic to follow up on. I don't really know, to be honest, and now I feel like I might be investigating that because I'm really interested. So stay tuned. We might include it in something in the future. So those are some three enforcement actions that are pretty big. But I will tell you, over the past year, they have been issuing consent orders nonstop. Now, not all of them have resulted in these large fines. Some of them have just simply resulted in, you know, hey, you need to reevaluate your procedures and policies, your business practices. This is a warning. This is a slap on the hand. Some of them resulted in, you know, more dollar amount or monetary fines, and some did not. But they have been very, very active. And I'm sure you kind of see a theme right here, which we'll talk about in a minute, but they've really been going after big banks. And we're not going to see that stop. So if we keep moving forward here, kind of just a look ahead of what to expect in 2023. And Ellen, I don't see that we got any other questions to date, but I really can't tell, so I'm going to ask you, do we have any other questions that I should address now, or can I go forward?
Nope, you can go ahead.
Great, thank you. Okay, so people ask, what do you think the 2023 holds for the CFPB? And quite honestly, I think, like I said, in November, people thought they'd kind of lay low until this whole appellate court ruling saying that their money isn't their money, or they didn't get it, properly. But that's not the case, as we just saw. They just issued that Wells Fargo one in December. So 2023 really shows no sign of slowing down. So even while they're facing this uncertain future with the appeal to the U.S. Supreme Court, what we expect to see them focus on at this point is big banks. We say big banks beware. So expect to keep up the pressure on the nation's biggest financial institutions for multiple reasons. One, I mean, quite honestly, they have the most transactions, right? So they have the most room for error and transgressions. Two, they can pay the biggest fines. So if you're going after the big banks, you can impose bigger fines. You have more money going to this victim relief fund, and you are seen and kind of feared more, right? If you're collecting billions of dollars instead of $100,000, it's kind of a big deal. I had to throw this in here, the Silicon Valley Bank, the impact. I do think this is going to be an impact. They're going to use this as a reason to audit and go after some more of the bigger banks. I know SVB is not a huge bank, but they were big enough. And interestingly enough, one impact that we have seen that has nothing to do with the CFPB, but since, the turmoil of it, the Fed have lowered the interest rates over the past couple of days, which is a good thing for us. But it is a direct impact from the SVB bank. I could spend a whole hour talking about what we think happened there and how they're getting bailed out or not, depending on how you view it. But I do think that they are going to use that to their advantage and say, hey, we need to have a stricter hand and a bigger net on these big banks where all this money is to protect your small mom and pops and their money, and we need to do more audits. So stay tuned to that, but that's what's expected in 2023. They are definitely going to focus on what they consider surprise fees, overdraft fees, and credit card late fees. They're already and have been focused on those. They're going to continue to, because that is one of the number one complaints from consumers. When they get a mortgage, I was quoted this, but then on my closing disclosure, I had all these fees, or I was told I wouldn't have an overdraft fee, or I paid my payment one day late for credit card, and now I'm, $50 assessment. So the CFPB is diving deep into that. They've been doing that over the past year. They even put out a request for public comment on what they call the junk and surprise fees. So I wouldn't be surprised at some point to see some additional rulemaking on this and some specific instances of issuing orders of consent for some financial restitution on these as well. They also are highlighting that they would like to crack down on discrimination. They updated their examination manual, which I don't think many people realize they did, but they updated the examination manual so that CFPB auditors will now be looking for illegal discrimination on a broad scale. So this is probably going to end up in some legislation at some point, because a lot of attorneys are saying that goes well beyond what Congress authorized the CFPB to do. And they were smart about it. They updated their manual so they can say, oh no, we didn't just send an auditor in there. This is what they're all doing to make it fair and equitable. So their goal is to determine whether banks are using unfair, deceptive, and abusive practices. This is definitely at some point going to hit a big bank or a big something, and there's going to be attorneys all around saying this is not within your scope, and it's going to probably end up in some litigation somewhere. So that'll likely be the next thing that we see. Another thing that I don't have on here that what they gave in their, they give a biannual update, the director does, to the Financial Housing Needs Committee in the Senate, and essentially they said they want to make data easier accessible for the customer. Meaning, if I bank with XYZ, or I have credit with XYZ or this lender, that the consumers should be able to access all of their personal financial information and not have to go through hurdles to get it. And are trying to look at easier ways for consumers to access their own financial information through the entities that they do business with. So I would expect some sort of task force or something like that, because that is kind of a new thing that they are looking at and trying to go after. Okay, so I think we've covered the CFPB, and again, we'll go back and look at this question, unless, Ellen, you see any that I need to go through right now. Otherwise, I will go ahead and
we have one more related to this Supreme Court case, which is, someone asked, if the Supreme Court rules against the CFPB, then what happens to all of the money and fines that they've collected?
That is a fantastic question, and one I posed myself, actually. I don't know, because this is all new. So they would have to stipulate, once it was ruled on, that they were in fact unconstitutional as an entity, they either Congress, it would likely be Congress that steps in, but it might be a directive from the Supreme Court that says, hey, you've got to use this money for this, that, or other, or return it. It would be very unlikely that they would rule for them to return money for banks that had, pretty severe, egregious type, discretions. But I don't know the answer to that, to be honest with you, but it's a great question, and it's one that we'll definitely come up with and be posed. And I assume if this ends up back with Congress, that would be part of the rewrite of the language and their constitutionality and what they needed to do with those funds. But at this point, I don't know the answer, but that's a great question. Okay, so Capitol Hill update. I'm sure most of you realize or heard the Secure Notarization Act of 2023 finally passed. They did have to keep updating the year because it's been on the floor for about 3 years. It came out in 2020, I think. It allows nationwide use of RON, which is remote online notarization. It creates national standards to be used. Keep in mind, individual state regs would still apply. It was, instead of every state having very unique ways of doing business, they thought, okay, can we just create like a national sort of regulations? And then if you have a specific state regulation that you need to use, you can, but at least across the board, they're used this way. And that came a lot from the MBA, the lenders. They wanted a generic national way of doing these remote online closings if they were going to do them. Also, it helps clarify interstate transactions and recognition around. So, where the property and the signers are not in the same state type thing, or properties are over county lines that go into a different state. A lot of times they can't do them right now. This would help with that. So it passed the House. it still needs to go to the Senate. I don't know when it will actually be heard. I don't know if it'll be heard on its own. I don't know if it will be tagged on to another bill, which usually happens because it's a pretty small bill. To be blunt, it's not that big of an impact at this point. Even past it, if it passes the Senate, it's just not a big it just simply means it's allowed. It doesn't really mean that your lender has to let you do it. The lenders say, we're not set up for that. So, okay, just like it is now. And when this was originally put out there, it was because a lot of states still didn't have emergency orders in for RON or RIN closings because of COVID, and we were trying to keep our industry afloat and be able to still do closings. So then, slowly states started adding emergency orders and said, okay, for this amount of time, you do a RON or you can do a RIN, where you can, physically sign it, but somebody's watching, so on and so forth. And eventually, more and more states just extended that emergency order. And I don't know the number. It was 42. It may be 44 now. States already have RON legislation in place. So, and by the time it passes the Senate, it's a nice backdrop to be able to say to a lender, like, hey, it passed. Can we go ahead and get this started if that's what you're wanting to do? But it's still not going to force a lender to utilize RON. It just says that, in any state, if it hasn't already passed and your lender wants to do a RON closing, they can. But again, it still has to pass the Senate, and it's a good thing for our industry. It's something they lobbied for years. It's just, it took so long to get passed that it doesn't quite have the impact that it would have in obviously 2021 or even 2022. But it's still good, specifically for the interstate transactions. But I would be, I'm not as excited about it as I was before, only because most states have their own legislation now. And again, it's still dependent on the lenders. And if the lenders are not set up for it or not going to approve it, most title companies are not going to try and force their hand. But still something to keep an eye on, still something to watch as it goes through the Senate. Oh boy, I wish we had a whole hour to talk about this, but I'm just going to give you an update. I mentioned earlier, if anybody happens to be going to ALTA, the American Land Title Association's Advocacy Summit in May, if you are a member of ALTA or if your company is, I would suggest it. It's a great opportunity to talk to your congressmen, congresswomen, and senators. And they have hot topics every year that they ask you to lobby for within your state. And one of them is absolutely going to be the AOL, the Attorney Title Opinion Letter. As most of you know, back in April of 2022, the GSEs, or specifically Fannie Mae, updated their selling guide to permit lenders to obtain either lender's title insurance or an attorney title opinion letter. So it's not forcing them to take it. It's saying either or. And it says in limited circumstances, and what that means is there are certain types of loans that they will not accept it, but they're not your everyday loans. So your everyday loans, this will be accepted. They have specific requirements that the attorney opinion letter must meet. It must be addressed to the lender and all successors and interests of the lender. The reason why they do that is because if they're going to take it, as almost all of you probably know, it does shift the liability and a much higher risk to the lender by not obtaining an actual title insurance policy. The attorney opinions letter is just that. It's an opinion of that attorney, and it doesn't cover as much as a title policy, and it doesn't have the same search as a title policy. So they're saying, if you're going to take it, we need to see that the letter is addressed to you and all your successors so that we know everybody knows you took this. Be commonly accepted in the area where the subject property is located. In that case, right now would be in the 6 or 7 attorney states, and then maybe in a few small areas. But attorney opinion letters are not generally commonly accepted in lieu of a title insurance policy. Now, that doesn't mean it won't change now that they've changed their guide, but in general, a title insurance policy is what is commonly used. They need to provide gap coverage for the duration when the loan closing and the recordation of the mortgage. So if you table funds and you don't record before you fund, and you maybe have multiple days. I live in Cook County in Chicago. It's not a quick process. So you can sometimes have a very large gap in recording. So that attorney opinion letter has to provide that gap coverage. They need to list all other liens and state that they are subordinate. They need to state the title condition of the property is acceptable, and the mortgage constitutes a lien of the required priority on a fee simple estate. And then the lender must report a special feature code 155 when they deliver that loan. basically, so Fannie and Freddie, it essentially flags the loan in the system that we are not using a title insurance policy. We are using an attorney's opinion letter, and it flags it for them so that they know that. So kind of to not be as technical here, excuse me, kind of, some people are like, well, what's the problem? It's still coverage. Well, it is, but it's limited coverage, as we all know, right? So the title insurance provides most comprehensive coverage to both lender and the home buyer. So why would Fannie and Freddie do this? So Fannie and Freddie are saying yes, but an attorney's opinion letter, if a lender is willing to take it, still has coverage, and the lender is saying it's okay, and it's cheap. It's generally much cheaper. So it's a more equitable way for homeowners to pay less as a consumer in buying a home. So it's really a way to reduce the amount of money that a borrower has to pay at closing. So what they're doing is they're also reducing the amount of coverage that home buyer is getting, and they're also shifting that risk to the lender, which could end up being pretty disastrous if not done right. So the use of this shifts additional risk to lender and reduces coverage. So it becomes a high risk to the home buyer, and why? Well, the reduced cost to the home buyer also equals reduced coverage. Level of risk is increased, meaning that you are not getting a thorough search. You're not getting an abstractor that goes out there and is searching record after record, 50 years, 80 years, whatever it is. The search is only on public records and very likely may not uncover very common everyday problems like federal tax liens, misindexed items, HOA liens, and stuff like that. So a lot of stuff can get missed. And what happens when that comes up, it was never covered in the first place. So now that burden is on the homeowner to fight that. And the legal costs are obviously going to cost a lot more than it would be if they would have just gotten a title insurance policy. It also offers them a reduced remedy to the homeowner. Right now, if they have a claim, they go to their title insurance policy and they call up their title company or their underwriter or whoever did their closing, and they file that claim with the underwriter. That's not the case. In many states, the attorney's opinion letter only really covers them, meaning they can only go back to that attorney that issued it for 1 year. So it's kind of anything above and beyond that they would have to fight on their own, or they'd have to go back to the lender and try and figure out a way. I don't have it on here either, but it also doesn't offer indemnity to the lender, especially after a time frame. So there's a lot of really kind of nuances here that could potentially cost a lot of money to both lenders and borrowers. The question that's always posed is, why would a lender take this then? And I mean, it's a really good question. In some areas, if it's fairly common, then they're going to do it, of course. And in other areas, if a attorney or a title company or a consumer borrower knows that this is an option, or they legally have to be disclosed, you can do this or that, and one's going to cost you this and one's going to cost you that. If Fannie and Freddie is saying, hey, we'll take it, it's kind of hard to tell the borrower, no, we won't take it. So it's kind of going to play out very interestingly, in my opinion. I don't see this like people jumping all over this and trying to get everybody to use them. But who knows what Fannie and Freddie are going to do in the GSEs, and if they're going to push it, or if they're going to make it, require that you at least offer it to them. I don't know what type of power they're going to take away from the lender and say, hey, you're the one that says whether you're going to take it or not. So it'll be interesting to see. But right now it is an extremely hot topic because they're painting it as, hey, we're here for the consumer. It's more equitable. We're going to reduce your costs. And it paints title insurance in our industry in a pretty bad light, saying, no, we want to force you to use a more expensive thing. What they're not shining the light on is, it's not apples to apples, right? It's apples to oranges. One gets you coverage, one you can sleep at night, and one is, gosh, I hope if anything happens, it happens in the time frame that I can go back and get some recourse. So very interesting. This is an extremely hot topic. It will for sure be one of the top things that will be lobbied on in Lobby Day up in Capitol Hill. Speaking of ALTA, I put this in here just as a reminder. I know it says 2021 and we're in 2023, but it's actually something we're still dealing with. Excuse me. ALTA 2021 forms, I'm not going to spend a lot of time on it, but I am going to tell you, they went into effect July of 2021. It is okay if you're still not using them, essentially was what I got going on here. Your underwriter will determine when you should use the new forms. Once they determine that, they provide them to, obviously, us at SoftPro. And as we get them, we produce them and release them to our docs portal. So if your underwriter hasn't told you to start using them yet, then you probably likely don't have to. We have the ALTA canned versions in there already. If your underwriter ones are not in there, you can obviously reach out. We can give you an update, or you can ask your underwriter directly. But it likely means that we're producing them in the order that we got them. They definitely had a decertification date of 12/31/2022, which freaked a lot of people out, and our poor support staff got inundated. But essentially all that was is it just meant as of 12/31/2022, they're only going to support the new forms. They're not going to update or make any changes to the 2016 forms, the 2006 forms. You can still use them, and that's fine, but you can't use the new ones. Like, you can't issue a 2016 commitment and a 2021 policy. You have to use both. So the decertification was not a cutoff date. That's when you had to use it. It just meant from that point forward, we're going to sunset them, meaning you can still use them. They're still available. We're just not going to update or make changes to them. So getting into the SoftPro specific ones here, your underwriter specific ones, most of them are in there. If they're not, we're likely already working on them with your underwriter, but feel free to ask us. And if you don't know where to get them, just call support. They'll help walk you through the docs portal. You can also reach out to your agency rep. I'm sure they'll help you as well. So we still got a lot of questions about that decertification and whether they need to be using it. And the answer is, if your underwriter hasn't instructed you yet, the answer is no. Also been busy. They also just revised their best practice framework program, and they just came out from version 4.0. Came out in January, and it has an effective date of May 23rd of 2023. It really, in a super high level, it touched on 3 different pillars. Before I even just talk about or kind of quickly review them, please know that this is optional. So, it just means that, like, as of May 23rd, you can't use the 3.0 anymore because you won't actually get, like, certified. They won't stand behind it. No one has to actually use the best practice. You should, but nobody has to go through the whole framework certification process unless your company wants to, or, that's their policy and procedure. So don't feel like you have to run out and do this, as of May 23rd. It's just, that's the version that they'll be using. They changed Pillar 2. They updates to the treatment of non-settled funds and outstanding file balances, use and treatment of fintech applications, escrow funds training, use of the ALTA outgoing wire preparation checklist, and the use of a wire verification. So that's a very high level of what changed on Pillar 2. And then Pillars 3 and 4. Pillar 3 is privacy and information security programs to protect MPI. I don't think that's a shock that it will be constantly updated as we have more cybersecurity and AI and we have more technology. And then Pillar 4 is a settlement, which they updated to include establishing consumer objectives for training of the staff, disclosures of ABAs, and so on and so forth. I'm not going to go in and just read you all this. You'll have this available. And you can also go to ALTA's website. They've got a best practice section. You can print out and view the PDF of the new version 4.0 framework. You can see what changed, and you can go through it and update your procedures if you want. But they've got some really great information on there. So if this is something that your company does or is looking to do, just go to the alta.org website, and all of this information is under best practices, and they've got a lot of great tools for you to use there. Which brings me to my last talking point. I know you guys are probably getting tired of hearing me talk. I only did one slide because I do not have a crystal ball, friends. I can promise you right now, I have thoughts. I always have thoughts. But I don't think this year is going to be as bad as everyone originally was talking about last year. Everybody was doomsday, 2008, blah, blah, blah. But here's my take on it. Well, one, we still have a very low limited supply, right? One of the reasons is new construction dropped again. They're not coming on the market as rapid as maybe people thought. And so the supply and demand is still an issue. The difference is it's not the supply and demand issue we had before, because not everybody's looking to move like they were before when we had 2.8, 3.0 interest rates, right? So one of the reasons why we don't see a lot of houses on the market is because everybody already bought them. Everybody was running to buy them in the past 2 years, and they're happily sitting with their low interest rates, and they don't want to move because they don't have any interest in going from a 3 to a 7% interest rate. I just talked about new home construction dropping again. That is expected to rebound in the second quarter 3 and 4. So we'll see and keep an eye on that. Housing prices are not expected to drop much more at this point. And that's a good thing. You know, they needed to come down. We needed to stabilize our market. We needed some sort of normalcy, or that bubble was going to burst and we were going to be in an '08 situation, because people can't afford to keep paying more and more and more and more when they're overpaying so much like they did in 21 and part of 2022. And now a lot of them can't move because they can't sell for anything that they purchased the house for too, right? You have that whole equity issue. So they're not expected to drop that much lower, and that's okay, because with the interest rates higher, you know, everything will start to stabilize and normalize. It will mean a slower market for us, but I mean, there's no way that the market could sustain the last 2 years. So every area is different. I know some areas are harder hit than others, and I don't mean to undermine it if you're in a super hard hit area. I can only speak to nationally. So housing prices dropping at a slower rate as far as prices is better than a super high or super low. So lower prices were offset with higher interest rates, right? So as house prices came down, the rates went up. So you didn't have as many people running out and buying things. The sticker shock of the higher interest rates are wearing off. People are saying, oh, yeah, actually 5%, 6%, 7%, that's actually somewhat normal. And so we had all through the, 2011, 12, 13, 14, 15, the 2.83, 3.1, that is insane, historically low, but that's what new home buyers saw over the past couple of years. So you have to give them a hot second to adjust that wasn't normal. It was historically low, not just low, historically low. And so now people are starting to warm up with it and say, okay, well, now I can afford it because there's $600,000 houses on the market for $490,000, which is what it should be. So my interest rate's up, that's okay, because now I can afford it. Also, remember, I told you the rates came down there because of the SPV right now. So I don't know if they'll keep coming down, but it's better than going up. Reality sets in, right? Sellers still want last year's prices. Buyers are looking to lowball negotiate. Sellers will come around if they do want and need to sell. They'll realize the comps will start, setting the tone. They're still looking at older comps. And buyers will realize, okay, housing prices are not going to come down as low as we thought, and this is what we have to deal with. So my advice to everyone is just really hang in there. A return to normalcy should be on the way. As great and all the business that we had in the past 2 years was, completely unsustainable and not good for long-term market. So I hope everyone got the benefit from it, but I hope you can all realize that even though we have this downturn in our market right now, caused by a lot of outside things, not just real estate, inflation, you got elections coming up, you got all that type of stuff. But overall, it is not as bad as people predicted last year. And in fact, a lot of head economists and chief economists are predicting that the market will steady itself, fix itself, and even be on a slight upswing by quarters 3 and 4. So obviously that's all conjecture. Nobody can actually say what's going to happen. But what we've seen so far has been nothing crazy drastic. Anything spiking high, spiking super low isn't a good thing. So since it's moving slow, people are starting to buy again. And I think that if we can just hang in there, it'll balance itself out. And we'll have, the first-time home buyers that couldn't buy the past 2 years will now be able to buy, and so on and so forth. So with that, I want to say thank you to everybody for joining us. I haven't done one of these on my own in quite a long time, so I appreciate you, listening to me talk for an hour. I know it's a lot, but I am happy to answer any questions that anyone has. I am happy to follow up with anything afterwards if anyone has anything. Again, as I mentioned, we will send a recap, which will provide the link to the recording. And then I believe you can go to our blog. It'll all be in the recap and see some of this information as well. But with that, I guess, Ellen, if there's no further questions, we can give everyone their day back. But again, I'm happy to answer anything.
Yeah, we're all set. Thank you.
Okay, thanks everyone for joining us, and be on the lookout for our next Save You a Seat webinar. We have some really great speakers and some really great topics, and I'm really excited. So, I'm gonna throw this out here, and Ellen, I didn't run this by Ellen, but I'm gonna throw this out here anywhere, friends. If any of you, are kind of regulars to our webinars, which we hope you are, and if so, we appreciate it. If any of you have a topic you think you'd love to hear about, some you think are hot topics or things you would love to sit and listen to a webinar on with some experts, feel free to email me anytime. I can't promise you will do them. They have to be kind of to the masses, of course, but we're always looking for input and and information from you guys. You know, we do these for you and we want you to get the most out of it. So if you have any ideas or thoughts, please just reach out to me at leslie.wyatt@softprocorp.com. And with that, I'm going to sign off and we will chat soon and have a great week. Thank you so much.